Today's topic is all about income splitting and how do you income split in a country that does not really permit income splitting in the traditional sense. So yeah, thanks for joining us. It's been a little bit since we recorded the last podcast. What have you been up to the last few weeks?
I went to Italy. That was
Nice.
the main thing. Yeah, that was pretty sweet. So yeah, that's pretty much all I've been. So I'm probably a little rusty, to be honest. See, I'm getting stuff caught on my sleeves and everything.
There you go. But you got your energy drink.
Starting to focus back up. Yeah, feels
There
good.
you go, locked and loaded. So income splitting, for those of you who aren't aware of it, in Canada, we do not file taxes jointly. You file and you name your common law partner or your spouse on your taxes, but you don't actually get to fully income split as a family. Walk us through. What does that actually mean? What are the implications of that?
Yeah, right. So like a lot of people think of, the US and a lot of other countries where you can actually like file as a household or as like a married couple. In Canada, you designate a spouse or a common law spouse on your tax return. Pretty much all that really lets you do is share some tax credits, which is a form of income splitting, probably like the basic form that people do without thinking about. For example, if you have a spouse who doesn't make any money and you've got the other spouse who makes all the money, then the spouse who doesn't make any can effectively share their basic personal amount. They call it the spousal amount. A couple other credits you can share, like student loan interest, stuff like that. Aside from that, basically you are charged your tax on your income individually. Right. So whatever tax bracket you're in is your tax bracket, and your spouse will be in their own tax bracket according to your own individual income. So then the question is, which is what we're going to talk about today and how to do it, is how do you split income?
And why would somebody want to split income?
The basic idea is to get income to be taxed in the hands of the lower earning person. Right? So shift income from the person in a higher tax bracket to the person in a lower tax bracket. Most of the time that's between spouses, but you can also do it between, for example, children and parents. And that's the overarching goal of income splitting.
Yeah, lower that, net tax liability for the overall household.
Yeah. And so, so what that does, right, is, now we're getting into it, is how does it actually help you save taxes, right? Which is the whole point of this, right? This isn't just splitting income for fun. The whole point is to save taxes. What happens, right, is when you have that money taxed in the hands of the lower earner as opposed to the higher earner, the lower earner is going to end up paying more taxes than they did before, but they're paying more tax at a lower tax rate. The higher income earner is saving that same amount of tax, or that they're lowering their taxable income, and they're saving tax at a higher tax rate. So as a family, you save tax on the difference between your marginal tax rates. So the example is if you have one spouse in a 25% tax bracket and another spouse in a 50% tax bracket, every dollar that you shift from the 50% tax bracket person to the 25%, you save tax at 50 minus 25%, 25%.
Yeah,
as a family.
you're cutting your tax liability effectively in half,
Yeah.
if those are those rates. And there's lots of people in Canada who one spouse works and one spouse doesn't work for a multitude of different reasons. And so the more money you can transfer to that other income earning spouse, you're going to significantly lower the potential tax liability there.
Yeah, and like saving that much in tax is not out of the realm of reality, right? Like how many people have you seen in that very real scenario, like one person's in the 25 or like the lowest tax bracket, the other person's in the highest tax bracket?
Well, and it's more common too for like very, what I would consider like high income individuals, especially when you're, above that like 500,000 to $1 million a year, in income. We see it more and more commonly that the other spouse doesn't work because they don't need to, and then two, they pick up, other responsibilities and they take on other, kind of roles because it's just a more efficient way to do things rather than them getting a job making $50,000 a year, $100,000 a year, because it doesn't make that material of a difference, especially when you can do things like income splitting as much as possible.
Yeah, exactly.
Cool. So, obviously that kind of explains how it helps save in taxes. So what are the rules around income splitting? So the big one for a lot of people to understand is kind of income attribution. So, traditionally you can't just income split, you can't just pass that income over, but there are certain ways that you can do it. So what are the ways, or what are the penalties effectively if you do it the wrong way?
It's in the name attribution. And if you don't know what attribution means, it's very simple. If you don't follow the rules properly, then that income that you tried to split with your spouse, with your child, whatever, is going to get attributed back to you. Basically, the CRA is going to treat it like nothing happened. They're going to tax you on that income as if it was earned in your hands to begin with.
And there are certain scenarios, especially as it pertains to corporations, where they will actually penalize the spouse for attempting to split income and tax them at the highest marginal tax bracket, so that if the other individual who's splitting income isn't in the highest tax bracket, now it's actually a bit of a penalty tax for attempting to do it. So you definitely want to make sure you're doing it properly.
Yeah, exactly. And so the attribution rules we'll talk about. Do you want to go with the first one? What's the attribution rules for spouses, between spouses?
Yeah, so between spouses, in terms of attribution, and I guess in terms of, if you gift money to a spouse to invest in, their name in their non-registered account, you can't just do that. You can't just gift money to a spouse and have it taxed in their tax bracket. If you do that, the income that you're generating on that investment will be attributed back to the spouse who, effectively gifted that money, because that gift is not allowed from a tax perspective.
Mm-hmm. Yeah. And so with spouses, right, you have to play around the rules, right? This is where people talk about tax loopholes, right? We call them strategies, but, two sides of the same coin.
There's no such thing as a loophole in the Income Tax Act.
Yeah.
I mean, it's well over 3,000 pages. It's pretty well thought out. They're not loopholes. There's just certain planning techniques that are actually written and implemented in there. You're not pulling one over on CRA and kind of getting away with it. These are specifically designed in the Income Tax Act.
And yeah, to that end too, right? It's like none of this stuff is limited to really wealthy people, right? Anyone who has taxable investments, this applies to. So in other words, if you've, for the most part, maxed out your TFSA and your RRSP, like your registered tax sheltered investments, and you have more money to invest, now this stuff starts applying to you.
Sure. I would even argue it starts even if you haven't maxed those things out, because like you say, that's an exact perfect example of an income splitting technique, is making contributions to RRSPs or spousal RRSPs or to TFSAs, which we'll obviously get into here. So why don't we start with income splitting strategies before retirement? So we've got a list of them here. Number one on your list, you had higher earner pays the expenses for the household. What exactly does that mean?
Yeah, so I kind of put these in order of, to a certain extent, most simple to most complex. The simplest way to split expenses, to split income, is having the higher earner pay the household expenses. And what this does is the lower earner, the person in the lower tax bracket, to be saving and investing their money. And then that investment income is going to get taxed in their hands at their lower marginal tax rate. So again, going back to that, run with this example for the whole podcast, one person in a 50% bracket, one person in a 25% bracket. If you're getting as much investment income tax in the person in the 25% bracket's hands, you're saving basically 25% on every dollar earned in investment income.
Totally.
And it doesn't require any fancy setups, anything really. The higher earner pays expenses.
You just got to track it. Yeah. And for people who are listening, the main emphasis here is, let's say that lower income earning spouse is, earning $50,000 a year. The other one's earning, $500,000 a year, right? The whole idea is that $50,000 that one individual is earning, have 100% of that net income after tax go to the investment account. And then we just bookkeep it that the higher income earning spouse is actually paying all the expenses of the household.
Mm-hmm. Yeah.
And that's how you do it. You got to make sure you have some bookkeeping there to back it up, because you don't want to see the higher income earning spouse has a big bonus that pays out and they're getting $100,000 cash. And then all of a sudden it goes into the non-registered account of the lower income earning spouse. Something doesn't check out there, right? It's very clear that you are breaking the rules of it. So none of this is breaking rules, but you do still need to track it and have some bookkeeping to match up with what you're actually doing.
Yeah. Joint accounts are great for a lot of things. They do make income splitting. Most of these strategies, they make a little harder just for the bookkeeping reason, right? Once the money gets kind of muddled up in the joint account, it's a bit harder to be like, this amount came from this person, this amount came from this person.
And a lot of accountants, we'll hear mixed reviews from different accountants. Some accountants are okay with setting this up in joint accounts. Some accountants are very adamantly against it. There's obviously other benefits with joint with right of survivor from an estate planning perspective. But usually, typically the cleaner the better, right?
Yeah.
Just to have it separated out, because it's easier to track. It makes our lives easier, honestly, as planners too, when we can just see it nice and clean.
Mm-hmm. Yeah, definitely.
Cool. Second one you got here, using TFSAs. So how can you use TFSAs to income split?
Another really simple one, right? You can't contribute directly, you can't take money from your bank account and put it into your spouse's TFSA, but you can basically this is the one time where you could basically gift your spouse money. No sale, no fair market value, nothing, just give the money. They put it in their TFSA. Now, because it's in the TFSA, there's no tax on the income in the first place. So basically, you and your spouse can both max out your own TFSAs, even if it's all technically the money that originated from the higher earner's income, without facing attribution.
Absolutely. And
now you're maximizing tax-free in case that wasn't clear, now you're maximizing your tax-free investment income.
The best practice is to have a letter that outlines it, to say that this is money that was gifted. I'm just giving it to them. That's kind of the best practice, is to actually have that letter drafted. Cool. And then, so using TFSAs, what about using RRSPs or spousal RRSPs? What is a spousal RRSP?
Well, so first, on the topic of the TFSA versus RSP, a lot of people would think, oh, because the investment income isn't taxed like on an annual basis inside the RSP, that means, or that should mean, you can also just gift it directly to your spouse to invest in the RSP, and that you can't do. Right now, that would actually trigger attribution, and it's a nightmare because the investment income isn't really tracked, and so it's really tough. So with RSP specifically,
to be fair, it is one of those things that CRA almost never really looks at or catches. However, don't do it. You're not supposed to do it.
Now we're talking about loopholes in the truest sense.
I mean, have the paperwork to back it up, right? I mean, everything that we talk about, we want to err on the conservative side of CRA, follow the Income Tax Act, sleep well at night, don't play any games. But yes, effectively, you cannot contribute to a spouse's RSP, but you can contribute to a spouse's or a spousal RRSP.
Yeah, there's two main ways that you can accomplish the same thing. So the first one is with the spousal RRSP. Spousal RRSP is an account set up with in this case, like the lower earner as the annuitant, basically the person who's going to receive the money eventually from the RSP, and then the higher earner, the person contributing to the account, or the higher earner will be the person contributing to the account in the name of their spouse. And basically what this does is, way down the road, it allows you to split income with your spouse in retirement, for example. So basically you, as the higher earner, put the money into the spousal RSP, and you get to take the tax deduction, right, based off of your RSP contribution room. So you get the tax break up front, and then your spouse, way down the line, when they take the money out of the account, the spousal RSP, it's taxed in their hands. That's the general how spousal RSPs work. The only problem with spousal RSP, or not problem, but the spousal RSPs have kind of become obsolete because nowadays you can
income split that RIF income when you pull it out on the other end.
Yeah.
Now that being said, if you do plan to retire prior to the age of 65, and you and your spouse are, say, the same age, there isn't a large gap there, it can have a huge impact, because if you're trying to generate income prior to the age of 65, when you cannot split RIF income prior to the age of 65, now if you have it in a spousal RSP, it does allow you to split that income. Will you benefit from it? Depends on what age you retire, but there's literally no downside to keeping equivalent amounts in each of your respective RRSPs, just to keep your options open.
Yeah, exactly. And the reason for the pause there, I thought you were going to finish my sentence.
Oh, did you? Okay.
But yeah, and the only thing with spousal RRSPs is the one thing to note is the 3-year vesting period.
Totally.
Right? So if you put the money in and then like a year or two later, the spouse takes it out, it's going to be attributed. There's that word again, attributed back to you. But if you wait 3 years, then it'll be taxed in the spouse's hands.
Yep. And that also comes into play where if you're trying to income split sooner, like we'll see spouses that, take a leave or a sabbatical or, different types of things, and they have no income, we may decide to pull money out of RRSP accounts for that year because they're effectively in a very, very low tax bracket. And so you just got to be careful if you do that in years where there were spousal contributions, or like within that 3-year time period. We don't want to make withdrawals from a spousal RRSP because it's in a last in, first out, kind of basis, where it's not based on the original contributions when they were made. It's based on the most recent contribution into the spousal account.
Yeah, unfortunately, right? So I just had a client recently who opened a spousal RRSP, like they're about to be 71, thinking, oh, this is going to be the best thing. He was going to get to keep making contributions to his wife's spousal RRSP, only to find out, like, we can't touch that money for 3 years, and we don't have the choice because she's almost 71. So it's not really going to accomplish what you think it is.
Yeah, and it's not the worst case scenario. You might have still been better off tax-wise. It's just something to be aware of. You can still access the money. You're going to pay a bit more tax on it.
Yeah.
Makes sense.
The other way to basically income split with RSPs is you can't, again, contribute directly to your spouse's RSP. But again, going back to kind of the higher earner paying expenses, if say the spouse makes $50,000 in income for the year, and also assuming they have $50,000 in RSP room, they can contribute $50,000 that year to their RSP. If they contribute $50,001, that's what would kind of set off a red flag to the CRA being like, where'd that extra $1 come from?
Sure.
Right? Your spouse gave that to you. You can't do that. But as long as you basically contribute up to how much income you're earning for the year, while your higher earning spouse pays the expenses, then you're good to go again.
Yeah. Now the question obviously is, does that actually make sense to do? And it's going to be very situation dependent. If you're only making $50,000, it probably doesn't make sense to put $50,000 RRSPs. You may decide, and then you can carry forward that contribution rate. It probably doesn't make sense to use all the deductions that year. But let's say you are taking a sabbatical, you're going to be going back to work, or you took time off work with kids or things like that, and you might as well tax shelter the room because you know you're going to make those contributions down the road anyways. You might as well get that tax sheltering going, get back to your high income earning job, and then use those deductions in those years. Yes, it doesn't always make sense, but again, as I'm sure you can attest, we've run into just thousands and thousands of different scenarios, and there's just so many kind of one-off scenarios. We're like, oh, this does actually make sense in that scenario to implement something like that.
Yeah, exactly.
You just never know who's listening or watching this podcast. It always blows me away of people who reach out to us and say, oh, yeah, that actually makes sense for what I'm doing.
Yeah, right. Cool.
Sale of assets at fair market value. What do you mean there?
So this is another one where we're starting to get a little bit more complex, but this is one where, again, you can't, going back to the attribution rules, you can't just gift your spouse money to invest. But if you, for example, purchase an asset that your spouse owns for a fair market price, common classic examples of this are like vehicles. If you buy, for example, your spouse's vehicle at a price that's, the regular market price of that vehicle, then that money that you give them by buying their vehicle, and then you own their vehicle in return, now that money belongs to them legally, free and clear. So now if they go and invest that money, it is going to be taxed in their hands rather than attributed back to you. This is another one where, bookkeeping starts to become increasingly important for this and keeping track of this stuff. Again, making sure that it's a fair market value. If your spouse owns a $5,000 Honda Civic and you buy it from them for $20,000 so they can invest 20
or $500,000,
right? Not going to work.
Yeah.
But if you give them five, if you pay $5 for the Civic, and then of course, the spouse is going to own the car now. As long as your spouse isn't a good person, they'll probably still let you drive what was formerly legally your car. So that's the idea, right? And there's other assets you can do it with, like things like jewelry, like artwork, like anything that has like value, like couches that are worth like $100, getting harder and harder to do. Technically,
and then there is that point of like, okay, is it actually worth it to go through all this, hassle to do things like that? I mean, that's up to the individual.
Yeah.
Right. And again, it's mostly just a bookkeeping metric. So you can get pretty granular with it, or you might go, that's just too much work, to deal with it, to save, because if we're talking about the reinvestment of $25,000, right, in a household that might have, millions and millions of dollars, or even hundreds of thousands of dollars, they might go, it's not really worth it. But I agree, it is an option for additional forms of income splitting. And for a lot of our clients, that's what they want to know, right? They want to know that granular. They want to know, like, all right, if I can keep an extra $1,000 a year in my pocket instead of CRAs, I want to take advantage of that.
Our job is to help our clients save as much legally in tax as possible, right? Even if it is a little bit of like penny pinching, a little bit ridiculous. And really, too, if you think about it, what the sale of assets at fair market value is, it's retroactively going and having the higher earner pay expenses. So if you're going to buy a new vehicle, just have the higher earners pay the vehicle or buy the vehicle. If you've already bought your vehicles and now you're like, how can we save more in taxes? That's when you can kind of fix or adjust things moving forward. Spousal loans. So spousal loans, not as attractive right now. However, as interest rates come down, we may start to see, spousal loans become attractive again. What is a spousal loan? Spousal loan, and to be honest, it probably should have been towards the end of this list in terms of one of the more complex ones. I personally am not a big fan of spousal loans just because there's so many other easier ways of doing the same thing. But to your point, when interest rates are low, they can be effective. And so what a spousal loan is it is a formal loan set up at, this is very important, at the CRA prescribed rate. Basically, that's the rate that the CRA says this is a fair kind of market interest rate. If you charge any less than this, it's going to negate the whole strategy. So it's a loan from one spouse to another at the CRA prescribed rate, where interest is actually due and charged by January 30th of each year. Basically, the idea is instead of gifting the money to your spouse to invest, you loan them the money. Right, so you loan them $50,000. The investment income on that $50,000 will now be taxed in the lower earner's hands. In return, the spouse who received the loan has to pay interest at the CRA prescribed rate back to the loaning spouse. The loaning spouse has to recognize that interest income on their tax returns and pay tax on it. And this is where it really comes down to what is the rate of return you plan on getting, or you expect to get on your investments, and also what type of investment income it's going to be. Because, for example, we'll get to that in a sec. What type of income and what the rate of return is versus the interest rate.
Yeah.
So, for example, if you loan your spouse, the $50,000, and your spouse plans to get 12% per year in capital gains, meanwhile the prescribed rate is 6%, you're actually not benefiting at all because capital gains, for now anyways, are taxed at half, right? So effectively, you're going to be saving tax on 6% investment growth and paying 6%, and it's going to kind of negate the whole process.
Yeah, typically these strategies make sense when the prescribed rate is kind of like sub 3%. There's always going to be, additional scenarios. We had a period of time, I think it was like 2015 to 2020 where we had to, or 2021-ish kind of thing, where we had a ton of spousal loans set up. And it was pretty typical scenario where you've got, let's say one spouse sold a company, they're sitting on, let's say 10, 15 million in a non-registered investment account, right? It's all of the growth is going to get taxed in their hands because the other spouse was never on the corporation, right? We want to gift half of their, not gift half, but loan half. It's you loan 7.5 million to the other spouse when they're retired. One is paying, 1% in interest to the other one. Absolutely. Makes perfect sense. But then we saw rates come up. And the nice thing is once you had those spousal loans set up, but that rate is locked in for good. So we still have some of these on our books. We're not really setting up new ones right now, but we have lots of them on our books still from prior because it absolutely makes sense. Now each spouse has, $7.5 million invested and growing rather than one with 15 million and one with zero.
Yeah. And again, it just comes down to the interest rate and the rate of return on investments, right? If you're making that positive spread, it's going to be worth it.
Yep.
Right.
And then the key is that you have to make the interest payment within the first 30 days of the calendar year, not the first month, the first 30 days of the calendar year. Otherwise, it puts the loan offside.
And and it is like a formal one. Like you really need to document it, right? Like
Correct.
with a promissory note, for example. It's not just like a piece of paper in handwriting saying.
And it's nice when
loan.
it's nice when you for a lot of accountants prefer to see. We get different accountants, different opinions on it, but in general, it's better if you can actually like write a check or actually see money, kind of transitioning. That's why joint accounts aren't as clean for this because people set it up and they'll have the bookkeeping in behind it, but it's not as clean. It's better if like you each have separate accounts for it. I understand there's you're getting rid of the joint with right of survivor on joint accounts, but it's generally a better way to do it because it's cleaner from CRA's perspective, especially when you're getting into, $5, 10, 20, $30 million plus. It's probably going to get scrutinized or audited at some point.
Yeah. Which is why this is becoming, like, these are starting to get more complex, right?
Totally.
Definitely worth it, depending, but.
Absolutely. Yeah. Not right now. We've done lots and lots of them in the past.
Yeah.
Cool. Second generation income.
So this is, kind of another way that.
Probably the most complex one from a bookkeeping standpoint.
Yeah, from a bookkeeping for sure. So basically, again, you can't just gift money to your spouse to invest, but think of your compounding returns, right? Your earning interest, et cetera. So you can, if you gift money to your spouse, and let's say you have gift $50,000 again, and it earns 10%. That first year, when the spouse earns $5,000, that $5,000 is attributed back to the gifting spouse and taxed in their hands. The next year, that $5,000 is going to earn further growth, assuming markets cooperate. That second round, if you will, of income, of growth, now that is called income on income or second generation income. That belongs to the spouse who received the gift, right?
Or child.
Or child, yeah. So basically, that's what second generation income is, and so that you can see why it's like so hard to track this, right? Because you're tracking the income on the investment income on the investment income, and the longer the strategy goes on, you could be tracking 10, 20, 30 generations of income, trying to track that whole back to like the original investment. That being said, especially if it's implemented over a long time, where you get time to really get those compounding investment returns, it can be a very excellent strategy for splitting income, right? Like if you don't have, any assets you can sell at fair market value, if spousal loans don't make sense, this is one way where if you implement it over, 10, 20, 30 years, it can be quite helpful.
And usually with larger sums of money, right? Where one spouse is always going to be in the highest marginal tax bracket because of the fact that they have so much non-registered investment income. That's a way where you can start splitting income with, a spouse or with kids. I mean, obviously you could, it's less common a structured way because it's probably a bit simpler to accomplish with a family trust. But, barring having to set up a trust and some of the filing requirements there, this strategy does not require any of that. Cool. Okay. So that goes through a lot of the income splitting rules kind of prior to retirement. Now let's talk
There's
about.
one more.
Oh, is there?
There's one big one we forgot to put on the list.
You have two question marks. What did we forget to put on the list?
I remembered what the question marks were. Corporate corporations.
There you go.
This is a classic example, right, with TOSI and the kind of not that new anymore, but the new-ish rules that came out. You can't just like split, pay dividends to your spouse and your kids and do this.
Even if they own the company, you can't pay a dividend out to them unless they actively work in the business.
Yeah, and so that's the thing, though. If you do actually have, like, for example, let's say one spouse kind of more or less stays at home, but maybe they work in some capacity as an assistant. Or like when I was a kid, I worked for my dad's company cleaning his shop, and I earned a reasonable salary for the job I actually performed and the hours I actually worked. That is allowed. And that is a way of kind of technically splitting income, right? Is paying your spouse or your children a reasonable salary. And that's the key word, reasonable. So if they're working 2 hours a day as an assistant and you're paying them 80 grand a year, that's not reasonable, right?
Yeah, and the smell test is kind of what would you reasonably pay somebody else who wasn't related to you or a spouse or a child to the same amount of work.
Yeah.
Right. That's kind of the smell test. If you're looking for realms of reasonability.
Yeah, and if you don't know what a reasonable salary is, go on Indeed or like LinkedIn or just find positions, the similar type of positions for the same field, and then just prorate it based on the amount of hours that your spouse or your kid is working.
Yep.
There you go. Right.
Yep, absolutely. Cool. So in terms of, splitting income now in retirement, so that's obviously, accumulating assets and building it up. Now on the flip side, when you're retired, and this one will focus mostly on income splitting with your spouse, what are the different methods that you can income split during retirement?
So all of the above. Everything we've just talked about still applies, right? It applies for your whole life. But income splitting does get a lot easier once you're kind of in that retirement age, especially age 65.
65, a whole bunch of things kick on. There's some stuff prior to 65 in terms of certain types of qualified pensions. But yes, basically all pension income is effectively splittable after 65.
Yeah, and then you can just split up to 50% of it. So RIF and LIF income or any like PRIF, LRIF, like any of those kinds of locked in or non-locked in retirement income vehicles, all those can be split once you are 65, right, with your spouse.
Let's talk about just going through your list here.
Sure.
CPP sharing, right? CPP pension credit sharing is what they technically call it. How does that work?
Yeah, and that one's a bit more complex, right? It comes down to how many years you've lived with your spouse in a conjugal relationship versus and how many years you've contributed to CPP, and it's a prorated amount of that. So basically, if you've lived with stuff, it's hard to do in my head, but if you've lived with your spouse for all of the years you've contributed to CPP, you can split 50%. And basically both spouses are going to figure out the portion of their CPP credits, their CPP amount that they can share. And that goes kind of into a pool that is then split 50-50. So it's not quite as simple as like RIF and LIF income where it's just like, here's 50% of that amount on your tax return basically. But yeah, it's a prorated share based on how many years you've lived together while contributing to CPP.
Yep. So obviously if you've been with your spouse for a very long time, and you don't have to be married, it could be common law, anytime you've been filing your taxes jointly. Is how they'll look at it. So that's another advantage to starting to file jointly for people who put that off, even though legally they have a responsibility to be filing jointly. You'll still see it all the time where even though you're in a common law relationship, especially young people that don't do that, but that is potentially one of the advantages. Now, is that going to make a massive material difference in the long run? No. But however, any little time that we can get some tax savings by splitting more income, it's going to be beneficial. And now some people will say, yeah, but you can just split more of the RIF income to kind of make up for it. And sometimes you can, and sometimes you can't. And so I would just say that it's just easier when you apply for CPP to have that income splitting set up right off the bat. Why not? It's definitely not going to hurt, but a lot of times it is actually going to help.
Yeah, and to that point, right? Like there are so many things where if you just plan ahead, right, it's going to be you should be able to split basically all of your income exactly 50-50 in retirement, right? Which is why it's very beneficial to have that plan many years in advance rather than trying to retroactively, I'm 64, I got to rearrange many things, right? And that's,
a lot of times it's too late.
Too late, right? And like just to kind of take a bit of a sidetrack here, like a lot of people ask, what is, in terms of tax, what is the difference between a financial planner and a tax accountant? And the analogy that I like to use is a financial planner is kind of like the architect, whereas the accountant is sort of like the contractor. Basically, the financial planner's job is to kind of orchestrate and set up your assets, your finances in such a way as to provide the most amount of tax credits, deductions, opportunities to split income, for example. And then the tax accountant's job is to go in and know the tax code like the back of their hand and make sure that they're claiming every single deduction and credit and splitting as much income as possible, taking advantage of that structure that's been set up.
Yeah, one's a historian. They're looking back at, okay, what did you do over the last year? And we're going to maximize, your tax return based on that situation. And then what we're doing is we're looking ahead the next 10, 20, 30, 40 years and structuring things to take advantage of all the different planning opportunities so that you're not looking back 20 years from now and going, I wish I'd known that back at the time, right? Yeah. And that's you, like, to be honest, that's most people when they reach out to us, that's wise, because they don't want to look back in the future with regret and say, I wish I'd known that at the time, because it's the old adage, like, you don't know what you don't know. Yeah.
And unfortunately, a lot of people reach out, hey, what can you do for me now? It's like, go back in time 10 years and we'll help you.
To be fair, almost always there's stuff we can do.
Yeah.
But yeah, like the earlier on you can get started with these things, obviously the better.
Yeah, exactly.
Cool. Pension income. And when you write pension income here, you're talking lifts, you're talking like defined contribution, defined benefit. So you can income split that prior to 65 if it is a qualified. And then after 65, obviously you can continue to income split it.
It really does get a lot simpler once you're 65.
Yep. And a lot of people will say, I can income split it so I can give my spouse like 80%. No, it's up to 50% that you can income split. So I've seen that a lot online where people are like, yeah, you can fully income split. Fully income split means up to 50%. You can never split above that 50% amount. Cool. RIF, LIF income.
Talked on that, didn't we? Right?
We did. Yeah.
Once you're 65, right, and you start taking it, right? So if you're taking from an RRSP or like or a LIRA or an LRSP or anything like that, can't split it, even if you're at 65. But as soon as you convert to like the income vehicle, the RIF or the LIF, then you can.
And I have a bone to pick with that one. I think that is one of the dumbest things that exists out there. The fact that it's coming from effectively the same account. One's an RSP, one's a RIF. You have to convert it over to the RIF in order to qualify for that, right? So I've seen so many people that just defer. They don't have any defined benefit pension plan. And about 1/3 of Canadians do have a defined benefit pension plan. It's around 32 to 34% of Canadians have a DB plan. However, you'll see a lot of people who don't, and they don't start their RIF income until 71 when they have to convert it over, and they just missed 6 years worth of pension tax credits for both spouses. And is it a massive savings? No. But again, it's still better in your pocket than it is in CRAs, and it's specifically set up that way to reduce your tax liability.
Yeah, exactly. I also have the same pet peeve. Yeah, that'll be for the next podcast. When should you take your RIF and your LIF? When should you actually, how do you structure your withdrawal plan? Right?
Yeah, that's a loaded question. It's very situation dependent. And then the last one here, corp splitting. As we talked about TOSI, which is the tax on split income, which that's the acronym for people who aren't familiar with it. So that's income splitting from a corporation. So once you're over the age of 65, and again, this only applies to spouses that are both on the corporation. So if the spouse is in the corporation, you still can't dividend the money, right? At the salary portion, obviously you have to work, but the whole dividend, you can't dividend until they're 65 unless they actively work in the corporation. However, after the age of 65, you can dividend them out, which allows you to income split the money that's inside the corporation. So it's not uncommon for us to run into people with holding companies, $1, $2, $5, $10 million in there. You can't income split until 65. All of a sudden, 65 hits, and now you can fully income split.
Yeah, and basically it's just to equalize it so that people who spent their whole lives working, contributing to RSPs, are as opposed to people who were spent their lives, building up their own corporation, they both get the same kind of tax benefits at 65.
Yep, absolutely. Cool. Well, yeah, I think that's pretty well all the time we have for today. We've got some other income splitting things we can talk about in terms of children, maybe in our next episode. But for now, I think that was pretty solid. It's a lot of different opportunities for income splitting.
Yep, a lot. Folks with children, you'll have to tune into the next one.
Sounds good. All right. Well, thanks, Dylan.
My pleasure.
We'll chat again soon.
Cheers.